Hey AD30M on IMD Unders 2025 M Billo. When we talk about achieving long-term success in investing, most people tend to focus on returns, how much they can make, how fast they can grow their money, or what the next big winner might be. But the real foundation of sustained success is not about chasing the highest return. It's about finding the right balance between risk and reward. In other words, the real game is not about maximizing short-term profits, but minimizing long-term regrets. That's what intelligent investing is all about. It's about playing the long game with discipline, humility, and balance. The most common mistake investors make is thinking that they can outsmart the market, that through superior analysis or intuition, they can pick the best stocks or time the perfect entry and exit points. But even the best investors in the world know how difficult that is. The truth is that the future is uncertain, and no one, including me, can consistently predict what's going to happen in the markets, the economy, or geopolitics. What we can do, however, is prepare for the inevitable cycles of ups and downs that occur over time. And that preparation begins with balance, the principle of diversifying across a variety of assets so that no single event, crisis, or mistake can wipe you out. Diversification is the closest thing to a free lunch in investing. It allows you to reduce risk without necessarily sacrificing return. Think of it like running a business with multiple sources of income instead of just one. If one stream slows down, the others keep the business alive. Similarly, if one asset class or market underperforms, others in your portfolio may perform better, helping to stabilize your overall returns. The key point here is that in the world of investing, safety doesn't come from avoiding risk. It comes from understanding, balancing, and spreading it intelligently. When I started managing money, I learned very quickly that markets move in cycles, periods of growth followed by periods of contraction. These cycles are driven by human behavior, government policies, and global events. No matter how much technology advances, these patterns persist because human nature doesn't change. People get greedy in good times and fearful in bad times. That's why we see bubbles and crashes over and over again. So if you base your investment strategy on predicting what's next, you're setting yourself up for disappointment. But if you build a strategy that can endure all kinds of conditions, inflation, deflation, growth, or stagnation, you'll position yourself for long-term stability. To do that, you have to think like a risk manager, not a gambler. Risk management isn't about eliminating risk. It's about designing a portfolio that can survive under any circumstance. That's why I've always emphasized the idea of balance. If you only invest in stocks, you're making a bet on one particular kind of environment, one of economic growth and low inflation. But history shows that there are many periods when those conditions don't hold. In those times, bonds or commodities may perform better. If you blend these asset classes thoughtfully, you create a smoother, more reliable path of growth. Another important aspect of balancing risk and reward is understanding that returns are not linear. Compounding works its magic when you avoid big losses. Let's say your portfolio drops by 50%. You need 100% gain just to get back to even. That's why avoiding large drawdowns is critical. It's better to earn steady, moderate returns with low volatility than to experience wild swings of profit and loss. Over decades, consistency beats intensity. The investors who focus on not losing money tend to outperform those chasing quick gains. That's a fundamental truth that too few people appreciate. Now, balancing risk and reward doesn't mean avoiding growth assets altogether. Stocks, for example, are essential for long-term wealth creation because they represent ownership in productive companies that grow with the economy. But even within equities, diversification matters. You can spread across geographies, sectors, and company sizes. The global economy is dynamic. One region or industry may thrive while another struggles. By holding a broad mix of companies around the world, you participate in the overall progress of humanity rather than betting on a single outcome. It's also important to think in terms of risk parity, which is a concept I've talked about extensively. In most traditional portfolios, stocks dominate the risk even if they don't dominate the capital. For instance, if you have 60% in stocks and 40% in bonds, about 90% of your risk usually comes from the stock portion. A truly balanced portfolio should equalize the contribution of each asset to overall risk. That often means holding more bonds and other diversifiers than people expect. This kind of balance can make your portfolio more stable and resilient through all kinds of market environments. Cost is another factor that many investors overlook when pursuing long-term growth. High fees and frequent trading can quietly erode returns over time. That's why index funds and ETFs are such powerful tools. They offer broad diversification at a very low cost, allowing investors to keep more of what they earn. Over a few years, fees might not seem like a big deal, but over decades, they can make the difference between financial independence and disappointment. Keeping costs low and sticking with a disciplined plan are two of the simplest yet most powerful ways to enhance long-term performance. Emotional balance is just as important as financial balance. The market will always test your patience and discipline. When prices fall, fear takes over. When prices rise, greed takes over. The emotional cycle of investing often leads people to buy high and sell low, the exact opposite of what they should do. Successful investing requires self-awareness and emotional control. You must train yourself to think independently, remain calm in volatility, and stick to your principles when others are panicking. As I often say, the greatest mistake of the individual investor is to think that what happened in the recent past will continue to happen. The past is a poor guide for the future if you don't understand the underlying forces driving it. To achieve long-term success, you must view investing as a lifelong journey of learning. The market is a reflection of the collective behavior of millions of people reacting to new information every second. There will always be surprises, and there will always be mistakes. The best investors accept that uncertainty is part of the game. They focus not on being right all the time, but on making decisions that are well-reasoned, well-diversified, and repeatable. That's how you turn the unpredictable nature of markets into a reliable process for growth. If you look back over history, you'll see that the world's greatest fortunes were not built overnight. They were built by people who understood compounding, diversification, and discipline. They didn't get caught up in market noise or short-term headlines. They focused on principles that endure through generations. Balance is one of those principles. It's not flashy. It doesn't promise instant results, but it's what allows your portfolio to weather storms and still move forward. So, if you want safe long-term growth, stop thinking about what will make you rich tomorrow and start thinking about what will keep you secure for decades. Build a portfolio that reflects the reality that you don't know what the future holds. Spread your risks intelligently. Balance your exposure across assets that perform differently in various economic environments. Keep your costs low, your emotions steady, and your time horizon long. That is how you achieve true financial resilience. Not through speculation or luck, but through structure and discipline. In the end, successful investing is less about making bold predictions and more about practicing sound principles. The principle of balancing risk and reward through diversification is not just a financial strategy. It's a philosophy of life. It's about understanding that progress is built not by avoiding challenges, but by preparing for them. And when you learn to prepare rather than predict, to balance rather than gamble, you position yourself not only for financial growth, but for peace of mind, the most valuable return of all. Index funds and ETFs are among the greatest innovations in modern finance because they give every investor, regardless of experience or wealth, a simple, transparent, and cost-effective way to participate in the growth of the global economy. For decades, many people believed that investing successfully meant picking the right stocks or finding the right fund manager who could outperform everyone else. But over time, data and experience have shown that very few people, even the professionals, can consistently beat the market after costs and taxes. What most investors actually need is not to outguess the market, but to own the market efficiently. That's exactly what index funds and ETFs allow you to do. When you buy an index fund or an exchange-traded fund, ETF, you're buying a small piece of hundreds or even thousands of companies. You're not betting on one business, one industry, or one region. You're betting on the collective progress of human productivity, innovation, and economic growth. Think of it this way. Every time a new product is invented, a new service is launched, or a business expands globally, the value of the overall market tends to rise. Index funds and ETFs let you capture that growth without needing to predict which specific company will succeed. You're participating in the ongoing evolution of the world economy itself. One of the biggest advantages of these funds is diversification. In the real world, even the most promising companies face risks, competition, changing technology, regulation, or poor management decisions. By holding a large basket of companies through an index fund or ETF, you reduce the impact that any single failure can have on your portfolio. In essence, diversification turns uncertainty into reliability. It spreads your risk across many sources of potential return. That's why I often say that diversification is not just an investment principle, it's a survival principle. Another major strength of index funds and ETFs is cost efficiency. Traditional actively managed funds charge higher fees because they pay teams of analysts and managers to try to outperform the market. The problem is that most of them fail to do so over time. The higher fees you pay reduce your net return year after year, and over decades, that difference can be enormous. Index funds and ETFs, on the other hand, are designed to mirror the performance of a market benchmark, such as the S&P 500, at a fraction of the cost. By keeping costs low, you allow compounding to work more powerfully in your favor. Remember, in investing, small advantages sustained over long periods create large results. Let's look at an example. Suppose you invest $10,000 and earn an average annual return of 7% over 30 years. That would grow to about $76,000. But if your returns are reduced by just 1% each year in fees or inefficiencies, you'd end up with only about $57,000. That's nearly a $20,000 difference, lost simply because of higher costs. Index funds and ETFs help you avoid that silent drain on your wealth. They keep the process simple, automated, and inexpensive. Another benefit is transparency. When you invest in an index fund or ETF, you know exactly what you're buying. The components of a well-known index like the S&P 500, the Nasdaq 100, or the MSCI World Index. There's no hidden strategy or complex trading decisions made behind closed doors. You can see every holding, understand how it's weighted, and know that it follows a rules-based approach. That clarity helps investors build trust in their portfolios and reduces the anxiety that often comes from not knowing where your money is or what's being done with it. Perhaps one of the most powerful but underappreciated aspects of index investing is its alignment with compounding. Compounding works best when your investments are left alone to grow undisturbed. Every time you trade or react emotionally to market movements, you interrupt the process of compounding. Index funds and ETFs encourage a long-term mindset. They're designed to be held for years, even decades. As the underlying companies reinvest their profits, innovate, and grow, the value of your holdings compounds naturally over time. It's the quiet, patient growth that turns small beginnings into significant outcomes. Now, some people worry that index funds are too passive, that they just follow the crowd. But that's actually one of their greatest strengths. Most of the time, markets are efficient. Prices reflect the combined wisdom of millions of participants, each with their own analysis and expectations. Rather than trying to outthink all of them, the index investor says, I'll own a piece of everything. It's an approach grounded in humility, a recognition that the future is unpredictable and that consistency beats prediction. Over time, that humility often outperforms the confidence of those who believe they can see what others can't. ETFs add another layer of flexibility. Unlike traditional mutual funds, which trade only once per day, ETFs can be bought or sold throughout the trading day at market prices. This allows investors to respond quickly to opportunities or rebalancing needs while still enjoying the benefits of diversification and low cost. Some ETFs track entire markets, while others focus on specific sectors, countries, or even asset classes like bonds or commodities. Used wisely, ETFs can help investors construct diversified portfolios tailored to their individual goals and risk tolerance. One of the most effective long-term strategies is to combine several broad-based index funds and ETFs into a single portfolio that represents different parts of the global economy. For example, U.S. stocks, international stocks, bonds, and commodities. By rebalancing periodically, you maintain your desired level of risk while automatically buying more of what's undervalued and less of what's overvalued. This systematic approach removes emotion and replaces it with structure. It's a disciplined way to let the market's natural cycles work in your favor. The educational lesson here is that simplicity is often the ultimate sophistication. People tend to believe that complex strategies lead to better results, but the opposite is usually true. The more complex your portfolio, the more opportunities there are for errors, overconfidence, and emotional decisions. Index funds and ETFs simplify the process to its essence. Own the world, stay balanced, minimize costs, and let time do the heavy lifting. This is how ordinary investors can achieve extraordinary results. In my experience studying global economies and markets for decades, I've learned that success in investing mirrors success in life. It comes from having principles that work across many environments. The principle of diversification, low cost, and discipline embodied by index funds and ETFs is timeless. These instruments represent not just financial innovation, but also democratization. They give everyone, from the small investor to the large institution, access to the same growth engines that drive the world's prosperity. It's also important to recognize that index funds and ETFs are tools, not magic solutions. Their effectiveness depends on how you use them. If you panic and sell when markets drop, you lose the benefit of compounding. If you chase performance by switching between funds based on recent returns, you undermine the principle of discipline. The key is to stay consistent. Let your investment horizon be measured in decades, not months. Accept that volatility is a normal part of the journey. Over time, the broader market tends to rise because human progress tends to rise. Innovation, productivity, and global trade drive wealth creation. By staying invested through index funds and ETFs, you allow yourself to move with that long-term upward current. Ultimately, the reason these instruments are so powerful for safe long-term growth is that they align with fundamental truths about the economy and human behavior. Economies grow over time because people strive to create value, solve problems, and improve their standard of living. Markets reflect that cumulative effort. Index funds and ETFs are simply vehicles that allow you to participate in that growth efficiently and safely. They are not speculative tools. They are engines of compounding. So when you invest in them, think of yourself not as a trader, but as a participant in the ongoing story of global progress. You're sharing in the profits of human creativity and enterprise. You're aligning your financial future with the long-term growth of the world economy. And most importantly, you're doing it in a way that minimizes unnecessary risks, costs, and emotions. That combination, diversification, simplicity, and discipline, is the foundation of safe, long-term growth. It's not about being clever. It's about being consistent. And in the world of investing, consistency wins when it comes to building wealth safely over the long run. One of the most important lessons I've learned through decades of studying markets and economies is that no single asset class performs well in all conditions. Every investment, no matter how good it seems, has a time when it shines and a time when it struggles. The problem is that we don't know which environment we'll be in tomorrow, next year, or 10 years from now. The future is uncertain, and trying to predict it is a losing game. The smarter approach is to construct a portfolio that can perform reasonably well in any environment, one that's not dependent on guessing the future, but prepared for whatever it brings. That's the essence of what I call the all-weather approach. The concept behind the all-weather portfolio is rooted in a simple but powerful observation. The economy moves in cycles driven by a few key forces: inflation, deflation, growth, and decline. Every period in history can be understood in terms of how these forces interact. For instance, when the economy is growing and inflation is low, stocks tend to do very well because businesses expand and profits rise. But when growth slows or inflation spikes, stocks often suffer. In those times, bonds or commodities might perform better. The point is that different assets thrive under different economic conditions. The challenge for investors is to build a mix of assets that balance these forces so that your portfolio remains stable and productive no matter what the world throws at it. Think of it like designing a car that can handle all kinds of weather: sunshine, rain, snow, or storms. You don't know what the road ahead will look like, so you want a vehicle that can handle it all. I 900 am your 900 2025 m Bill. In conclusion, the journey toward safe long-term growth isn't about chasing trends or reacting to daily headlines. It's about mastering the timeless principles that govern markets and human behavior. Every investor, no matter how skilled or new, faces the same challenge: uncertainty. But the difference between those who thrive and those who struggle is how they prepare for it. The strategy I've shared isn't based on speculation or luck. It's built on balance, discipline, and an understanding of how the economy truly works. The best index funds and ETFs are not magic tools. They are instruments of simplicity and patience. They allow you to own a piece of the global economy, to participate in the progress of humanity itself. When you diversify wisely, keep why